So we move into Chapter 6, Receivables and Payables. And indeed, for any business, management of receivables and management of payables is crucial. Let's look at the first area, receivables. Now, what do we mean by this? Well, what we mean is basically monies owing to the business. So receivables are the amounts due to the business from individuals, organizations, or other entities to satisfy a debt or a claim. A typical receivable will be the first one mentioned in the example, trade receivables. So we make sales on credit to customers. We create within our accounts a receivable amount in the form of a trade amount. There are a variety of other possible receivables as well, obviously. Trade receivables would be probably the biggest, generally speaking, receivable that you would see within current assets. But you'll also have, prepayments or prepaid expenses. Note that if we pay something in advance that relates to a future period, e.g. the example here is insurance, then technically that's an amount owing to us. That is a receivable, but it's receivable in a future period. There may be other receivables that can't be specifically related to trade in some way, possibly a loan that we've made or some other amount. So in terms of receivables, broadly speaking, we know that they are current assets in the main, due within 1 year. Now, outside of that, in terms of offering credit, as I've said, the biggest receivable, generally speaking, for businesses will be accounts receivable or trade receivables. And indeed, to encourage businesses to buy more, or for individuals to buy more, businesses will offer credit facilities. So allowing to purchase goods or services for payment at some point in the future, 14 days, 30 days, etc., etc. What are the main advantages and indeed disadvantages? And there's certainly both sides here. Clearly on the left-hand side, if we focus on the advantages, if we're offering credit, is highly likely to increase sales. The sellers will more than likely buy more. It minimizes the need to pay now, to carry cash, or indeed to make payment. And indeed, certainly it makes perhaps more expensive items, point number 4, more affordable. Maybe we're offering credit terms over a period of time. Outside of that, certainly more recently, online shopping and the idea of being able to buy something or not having to pay or to be present at the point of purchase makes a lot of sense for buyers. So credit facilities and indeed offering credit facilities to businesses has a myriad of positives, a myriad of benefits, but it certainly may affect the flip side. There are some disadvantages. Indeed, for the customer themselves, possibly some sort of interest charge. There may be a premium for being able to facilitate a credit purchase. And for the business, second one down, credit facilities doesn't mean that everyone pays. You could incur legal costs. Some customers may not pay, or they may pay late, or they may refuse to pay. The administration, point number 3, associated with late payment and penalties, and may be costly to the buyer, but certainly admin cost or administrative cost for the seller, and also the risk of people just not paying. Outside of that, on occasion where credit is offered, security or some sort of guarantee may be required. That's a downside for the buyer as opposed to the seller. So credit facilities come in many shapes and sizes. There are positives and indeed there are negatives. This key point here, certainly I have a lot of experience of this dealing in public practice, credit control. If you offer credit to businesses, you better make sure that your credit control facilities are bulletproof. We mean chasing. We mean chasing accounts where people are perhaps not paying on time. And one area that's linked to that certainly is the idea of, well, who should get credit? Should you simply offer credit to anybody and everybody? And indeed, what are the terms of credit? And what's the credit limit for individual customers? You also obviously got to make sure that you invoice accurately. Now, in terms of this area of credit limit, what exactly do we mean? Well, it means that you should take the time to consider what limit a particular person or particular business should have. And that would generally be the result of some sort of review of their credit file. It's pretty easy to check an individual or indeed a company out online via these credit assessment reference agencies. So a credit limit is simply that, an amount to which you can go up to at a given point in time, but you cannot go over it. Okay? Sometimes, from time to time, credit limits may need to be reviewed, adjusted, possibly downwards. Our next area really concerns analysis. Let's just say that we have offered credit to a range of different customers. You know, our accounting system needs to be able to provide us with information to manage and to analyze. One way of doing that is the aged receivables analysis. Now, this is very simply a report of all receivables due, analyzed by name, with information relating to credit limits, cumulative turnover, as well as, importantly, the period, the age of the outstanding amount. So you might see, as we see in the next section here, an aged receivables report that has various columns. Okay, these are less than 30 days. These are less than 60, less than 90, etc. So really what an aged receivables account enables you to do is to assess who is over their limit. Let's say our terms are 30 days. We may have a range of customers between 30 days and 60 days. We may have some perhaps even over 60 days, between 60 days and 90 days, or some over 90 days. This is about risk. This is about analyzing where your risks are and really focusing your credit control efforts in the right area. A very, very useful report, that's for sure. Now, linked into that is the whole area of irrecoverable debts. What do we mean? Well, an irrecoverable debt is basically an accounts receivable which will likely remain uncollectible and should be written off. So we've made a sale. We've provided our terms to the customer on credit. The customer has not paid for 90, 120 days, and we decide as a result of communications with that customer that it's highly unlikely that that customer is actually going to pay it. So therefore, we have an aged receivable or an account receivable reflected in the accounts that we need to get rid of, because accounts need to be accurate. If it's not going to be paid in the future, we need to write it off. What does that mean? Get rid of it. We need to journal that entry to reflect that debt has gone bad. Okay. Now, what sort of factors would we consider? Well, fairly straightforward, really. I mean, when we think about, bear with me one second, just go back a little bit. You know, things like not responding, taking longer to pay, being 60 days overdue when our terms are 30, not responding to our calls, etc., etc. Really, the bottom line with, my apologies, the bottom line with, irrecoverable debts is, generally speaking, in business, customers tend to follow patterns, whether or not that's patterns of paying within terms or taking a discount or paying late or paying outside normal credit terms. So generally speaking, if the credit control department is tight and well organized, you should be able to not eliminate irrecoverable debts, but sort of guard against them. But you need to have systems. Now, in terms of writing off debts. What do we do? How exactly is that done? Well, the double entry is quite straightforward. We know that we have a sale that was made on credit, so therefore we have an accounts receivable amount that is showing as being due. We need to get rid of that. We need to journal that out. What do we do? Well, writing off a debt is an expense. It's an expense to the business whether we like it or not. So, as we can see from the dull entry shown in the middle of the page there, we debit irrecoverable debt. So we increase irrecoverable debts by the value, let's say $150. And we credit receivables. Why? Because receivables, we know, are an asset. To reduce receivables, we must credit. So to increase an expense, we debit. To reduce a receivable, we credit. And that's it. In terms of the explanation, we would need to put the reason in and obviously a little bit of detail.